Here are 3 things you can negotiate when you're buying your first home, and it's not what you think. I'm not going to be talking about negotiating the sell price down because everyone knows about that. There are things that you might not have thought about. And if you don't know who I am, my name is Meredith Silk. I'm the owner of Silk Mortgage. I've helped hundreds finance real estate, and I'm on a mission to make the mortgage process smooth and simple while offering the best rate guaranteed. So let's get into it. So number 1 is the interest rate. Now, you're never going to hear another loan officer tell you how to do this. They don't want you to know this strategy. So what you want to do is go to 3 different banks, get 3 different loan estimates, send them to each other, let them compete with each other on that, or you can use a mortgage broker like myself and have them do the shopping for you. Now, things to look out for on the loan estimates, because they're all going to be different. So not only looking at the interest rate that they're quoting you, you want to look at what's called Section A. You want to look at the discount points, how much they're charging you to buy down to get that rate that they're quoting. You want to look at if they have any underwriting fees, any origination fees, any processing, application, junk fees like that. And also you want to look at the loan type that they're giving you. Is it conventional, FHA, VA, what type of loan? You also need to know the term. So is it a 30-year fixed? Is it a 20-year fixed? Is it an ARM? You need to pay attention to those details. And also you will see on there, is this rate locked or not locked? And if you are not under contract to buy a house, then that rate is unlocked. And a lot of times what they do is they will promise you up front, they can tell you, I can get you a 2% interest rate because it's unlocked. And then once you go under contract, you go to lock in the interest rate. Well, interest rate has changed. So just be mindful of that when you're looking at the loan estimates. So number 2, closing costs. Now you can negotiate to have the seller pay for either all of your closing costs or a portion of your closing costs. And this is an extremely powerful strategy, especially when you're financing, because closing costs are separate from your down payment. And there's 3 parts to the closing costs. You have 1, the lender fees, 2, the title fees, and 3, setting up your escrow account. They pay for your home insurance up front for the first year and 3 months, and also a proration of your property taxes. So it could be anywhere from, depends on the purchase price, anywhere from $10,000 to $15,000 out of pocket. Now, a really good strategy, and you have to, whenever you're financing, you have to remember you're not a cash buyer. So when you're financing, you can use the seller's money to buy down the interest rate to get you a lot more lower payment. And here's how the math works. Let's say you negotiate the price down $10,000. Well, when you're financing usually for 30 years. And by lowering the price just $10,000, it only lowers your monthly payment about $50 a month. Now, as opposed to using that $10,000, pay down your interest rate, you could potentially save almost $100 to $200 a month by doing that strategy. And at the end of the day, the seller is still netting the same, so they don't really care which way you do it. So you just have to figure out what is a better strategy for me in the long term. So number 3, appraisal contingency. So this is something that you want to negotiate up front when you send in your contract initially. And the reason is the banks are only going to lend on how much the appraised value of the home is worth. And the only issue when this comes into play is if the appraisal value comes in less than the purchase price. So for instance, if you're buying a house for $500,000 and the appraised value comes in at $450,000, then you have a $50,000 gap. And this appraisal contingency tells the seller up front that, hey, if the value comes in lower, this is my out. I can walk away if you do not end up dropping the price. Because here's what happens at that point. Either the seller will drop the price to meet the appraised value, or you can walk away if they do not do that, or they will negotiate, try to have you meet them in the middle or pay the gap, and this is cash out of pocket. So it's very important to have this up front to give you an out, because I do not recommend anyone paying above appraised value, because essentially you're paying over what the house is worth. Now, if you're planning on buying a house, it's important to start the planning process now. So I hope you found this helpful. Consider subscribing, and I'll see you on the next one.